So why income in Asia? This is a chart you've seen earlier, so I'm not going to dwell on it, but I really do think it is important that I think people, when they think about Asia, they think it's a high growth region from an economic standpoint, and therefore surely when you go and invest in Asia, you want to be investing in high growth companies. And I think it's really key to remember that, you know, around half of that return that's come through over time, which is essentially the difference between the green and the dark blue line there, has come from that reinvestment of dividends. So it's something that's been there a long time within Asia, and I think it's something which I think you really need to pay attention to when investing in Asia. So what do yields look like today compared to other markets? If you look at sort of Asia Pacific, we're sort of around about just under 3% as a yield. Yes, less than the UK, but more than US and Japan. The Schroder Oriental Income Fund obviously is greater yield than that of the Pacific region, and also that of the UK as well. And at the same time, you're getting access to that higher growth region, which is what you can see on the right. And a lot of people sort of question whether does it, you know, actually do higher growth rates economically translate directly into stock market returns? And I think we could have a long debate about that. But I think it's easier from a corporate perspective to grow cash flows, grow your dividends, if you've got a stronger economic backdrop. The other question that people sort of do ask is, well, Asia is a more volatile region than, say, the UK. So should we be worried about the sustainability of dividends? And I think there's a couple of points to make here. Firstly, sort of payout ratios for Asia, which is the green line on the left-hand chart there, have been in that sort of 30 to 40% range now for an awfully long time. And that's literally the amount of earnings that companies are paying out. So if earnings growth does slow down, there is potential for them to allow dividend payout ratios to rise and to compensate for that. And you can see that that's what sort of historically has happened. The blue line here is trailing earnings. As that's sort of gone up and down, when earnings have come down, payout ratios have risen a bit to try and ameliorate that fall in absolute level of dividend. And you can see it most starkly in the sort of GFC, the global financial crisis. Earnings came under a lot of pressure. Companies tried to maintain their dividends or not cut them as much as earnings came down. Otherwise, the green line would have gone straight across the page. And that meant that dividends weren't cut as much as earnings were. So they are quite resilient. And actually, when you look at the sort of leverage of the region as well, you can see it's relatively low. So that's the right-hand chart, and the light blue line at the bottom there, that's the gearing, so how indebted companies generally are. And it's a lot less than other regions. So when things do get tough, you're not having to necessarily worry about, you know, the cash flow being taken away straight away from paying a dividend to servicing debt and so on. So again, it makes, I think, for a more resilient story than you might otherwise think that they'd be. And I think the best example of it is almost when you sort of, you know, when we think about, you know, traumatic events and we think of COVID. If you remember what happened in the UK corporate sector went into that with, you know, quite high payout ratios, quite high levels of indebtedness, and what you did see was quite big cuts to dividends and cancellations and so on. Yes, you saw cuts in Asia as well, but they weren't as substantial as they were in other parts of the world. So let's talk a bit more about the Oriental Income Trust and what we're trying to do. It's obviously a closed-end investment trust, and it's very much focused on generating an income principally out of the Asia Pacific ex-Japan region. We're hoping to offer obviously a reliable yet growing yield over time. And it's one of the largest income investment trusts in Asia. It's got about net assets of about 700 million pounds. So how do we invest? Like the previous speaker, we really think you absolutely need to have a fundamental bottom-up approach to investing in Asia. It's, you know, it is, in our view, an inefficient market, and the best way to get to extract those inefficiencies is through a bottom-up approach. We have an extensive team of analysts based out on the region, over 40 analysts. They're based in 6 offices. They're going out visiting companies regularly. They're setting fair values, writing reports. I'm drawing on their best ideas from a income rationale perspective to construct a portfolio of around about 60 stocks. And within that, naturally, you'd expect there to be a quality bias, which there is because of that sort of fundamental bottom-up approach. I think what's important to say is that what I'm not doing is screening the universe for the highest yielding stocks and backfilling the portfolio with those highest yielding names. And because often when you do that, those stocks end up cutting dividend, they don't less opportunity for growth. So what I'm trying to do is buy into companies where there's an income rationale for it to go into the portfolio, but I can also hopefully see upside to fair value as well. And that is a sort of one of the key things that I'm doing. So in effect, I'm not buying yield for yield's sake, but I'm looking to buy companies that have got enough yield essentially to pay the dividend at the end of the day. And this does mean there are areas of the market where I'm going to have less exposure to than, say, a broader Asian fund. And that would include, for instance, in the internet platform companies, the e-commerce players, the JDs of the world, the Alibabas, and Tencents and so on, where the income is or dividend yield paid is less, and it's harder to make an income case for those names. So from that perspective, the style of the fund, if you like, is going to tend to have a bit of a value tilt to it, because it will be ultimately, overweight income, which is a value factor, if you like. So what's been the outcome? What's been the experience for investors? This chart, it's got 3 lines. It's quite simple since inception. The light blue line is the FTSE 100. The green line is the sort of regional index return. And the dark blue line is the sort of NAV return of the Schroder Oriental Income. And I think the key thing here to get across is that Asia has been quite a good place to have your money over the longer term relative to the UK. And it has been a place where an active manager can actually add value. And you can see that from the top line that we've managed to add value consistently. Well, it does vary through time, but over the longer term, we hopefully can add value, and it has done that historically. So I think Asia is a very good place for active fund management. And I think for someone who's got quite a lot of UK income, I think it's a market where or an asset class which can act as a pretty good diversifier away from UK income, given the sort of historic characteristics of the outcome, at least. I won't dwell on this in the interest of time. So what's the sort of dividend progression been? It's been pretty steady over time. The dividend has gone up every year since inception, and it aims to pay its dividends out of revenues which have been generated. So as in dividend paid from the underlying stocks in the portfolio, and it carries forward a sort of a healthy revenue reserve. So it's not trying to either pay out a capital or generate extra income from writing options or these sorts of things. It's a bit sort of plain vanilla in the sense that it's trying to generate income from the underlying names in the portfolio. So what about the sort of, what does the current setup of the fund look like, or the trust? First thing to say about Asia is that it is really very much a heterogeneous region. It's not just about China. And you get lots of different diverse exposures from investing in Asia. So you get the sort of exposure to North Asian markets like sort of Taiwan and Korea. And they're obviously quite export driven, so they tend to be impacted more by the global cycle in a lot of things, or the economic cycle. IT is a real sort of a stalwart of these countries from a sort of an investment perspective, and you get world-class companies like TSMC, Samsung Electronics, etc., which and it makes up roughly just over a third of the portfolio at the moment. The other sort of big block is China, including Hong Kong. And there we are within the portfolio quite underweight China, but overweight Hong Kong. And sort of one of the challenges we find with China is around some of the sort of macro challenges, such around demographics, overinvestment, and geopolitics. But as an active manager, you can always find stocks that you want to put into the portfolio. So we still have quite a good exposure to that region. And then the third block I'll highlight is ASEAN, about 20% of the portfolio. That's really made up of companies that, well, the biggest market there is Singapore. It's a good quality market. It's obviously becoming increasingly important as a financial center through time. And it also acts as a sort of, if you like, as a way of accessing into quite a lot of its hinterland around sort of the rest of Southeast Asia. And so the other markets there would be things like Thailand, Indonesia, Philippines, Vietnam. And these are countries which are sort of benefiting from the China plus one policy. So very much about sort of reorientating supply chains out of China and into the rest of Asia, just to diversify the supply chain, reduce the risk, etc., and also just quite frankly take advantage of lower costs in some of these markets as well, particularly for lower end products. And then finally, last but not least, I should mention Australia. Again, just under 20% of the portfolio, quite a mature market, but quite a high return market. Generally, companies there being quite good about returning cash to shareholders. It might seem obvious, but it is a large country. It's got a relatively small population. That means that the sort of cost to serve is quite high, and that does mean that you tend to get sort of quite good industry structures in a lot of industries, which means that they're generally quite profitable and the ability to return cash is good. So acts as a good sort of diversifier from that perspective. What have markets done over the last year? Well, Asia's actually done, of course, really pretty well. It's up over 20% during the course of the year. You can see the returns by country on the left, by sector on the right. I'm not going to go through all of them, but there's been a pretty high spread. And I suppose one of the things that, surprises almost is how well Asia's done. And I think that's partly around people becoming a bit more confident about sort of stabilization out of Chinese growth, and also about at least getting a better feel for where we might land in relation to Trump tariffs, although nothing obviously is certain there, but there's a bit more sort of understanding of some of the sort of parameters at least. And then the other thing which has been driving Asia has been around sort of tech and AI in particular, which has been helping the markets like Taiwan in particular, and the IT sector, which have obviously been pretty strong. And I'd say also just the general liquidity environment's been pretty positive for Asia. The US dollar being weak is traditionally or has been a bit of a tailwind for Asia, and that's what we've been seeing over recent months as it's been weak. And you can see that, actually it's pretty good inverse sort of correlation historically. So the green line is the US dollar. The dark blue line is the Asian index. And you see, generally speaking, if say the late 90s where the US dollar was strengthening, green line going up, that was a bit of a headwind for markets, tightening of liquidity, just generally slowed growth, etc., real rates going up a bit, that sort of thing. But when we got to sort of a period of easing liquidity, US dollars weakening, generally a good backdrop for Asian markets, and that's what you saw through the sort of 2000s. And that's sort of something which we've seen more latterly, which is obviously just starting to come through a bit of weakness in the US dollar. So that is generally helpful, and it's helpful because it allows monetary policy in some of these markets to ease and real rates to come down, which is good, obviously, for domestic growth and so on. Just quite conscious of time, but if we look at valuations, where are they today? So we've got just the historical PE of Asia on the left-hand chart, and what I'd say about that is that it's sort of given the rally we've seen, it doesn't look particularly cheap versus history. It's sort of in line with the very long-term averages, but if you look at the last 10 years, it's sort of popped its head up above that. So it is a bit more fully valued against its own history. But as with the previous speaker, it is Asia as a region looks pretty attractive versus other developed markets, and that's the right-hand chart, which just looks at the sort of, if you like, the PE of Asia versus developed markets, and you can see we're back down at the sort of, you know, the lowest level that we've been for sort of 20, 25 years. Again, I won't go through all of these. This just looks at the different valuations of each of the individual markets by PE. And I think the takeaway is that, you know, some markets look pretty fully valued in the sense of trading right up near towards the high end of their ranges, like India, Australia. Other markets like ASEAN and some of the and places like Hong Kong, for a valuation perspective, at least versus history, look relatively good. Again, though, the important thing is that it's a distribution of valuations, and what that means is if you're an active manager, you can sort of exploit that. How do income stocks look relative to the rest of the market? Are they particularly cheap at the moment? Well, if you look at the left-hand chart, we're looking at the PE of the sort of highest 40% of the market from a yield perspective. So those which are generally high yielding. And you can see they're trading at roughly just over a 20% discount to the overall total market. Up from the bottom, but still not expensive by, you know, if you look back to sort of the early to mid 2000s there. And just if you look at the yield differential on the right-hand side there of Asia vis-a-vis the world index, as it were, you can see that, again, the spread of Asian yield versus the rest of the world is pretty high. So in that sense, I think Asia still looks relatively attractive from a income perspective. This just looks at the portfolio where we are today in relation to country positioning on the left and sector on the right. Again, not enough time to go through it in any detail, but I think the sort of takeaways are very underweight in China, partly offset by Hong Kong, and I'll talk a bit more about that in a minute. And then, but that largely comes through an underweight in some of the internet platform companies, which include some of the e-commerce names, and that's why sort of underweight consumer discretionary as well. Overweight financials and information technology, continue to like those, have been consistently overweight time, although they have done well, and so therefore have been taking some money out of those areas of the market. So why am I underweight in China? And I think there's a couple of big reasons for that. The first is just it's been pretty tough going from a sort of broad consumption perspective in China, the recovery coming through. And that's really been driven about, despite stimulus, it's been driven by a lack of consumer confidence. So you can see consumer confidence has completely come down during COVID and has never recovered. And what that's meant is that a lot of savers have just, or a lot of consumers have just increased their savings rather than spending. So interest rates coming down hasn't seen loan growth come through. So it's a pretty slow recovery coming through in China. The other key thing I think just to point out is that China is a market where you see quite good growth in certain sectors. And the problem has historically been overinvestment. So you end up with a lot of capital going into a sector, and therefore that drives down the returns. And that doesn't necessarily mean isn't great for stock market returns. And so what that ultimately ends up like, particularly in a slow environment or in a sector which has matured, say like e-commerce, which here's just the year-on-year rate of e-commerce sales, which used to be at that 30% range. You know, we've now maximum penetration of, or high penetration of e-commerce, and a weaker sort of same-store sales growth obviously means that that's come right down. What that does mean is, if you look here on the right, that although the country has grown, that's the green line from a nominal GDP perspective, pretty robustly. Actually, EPS, which is this bottom line, has not followed. And that's where you sort of get the problem of the translation between GDP growth and stock market returns from a Chinese perspective. And one of the reasons we find ourselves, although we're assembling the portfolio from a bottom-up perspective, why we're underweight. So what do we like? I think there's some key sectors and themes going through the portfolio. I've sort of talked about the tech leaders, TSMC, Samsung Electronics. They're a strong long-term growth story and have been these tech leaders for a while, just simply because there's been so much consolidation within, say, semiconductor production over the last 20, 25 years. As technology has progressed and advanced to smaller and smaller geometries, it's harder and harder to do. Less companies can do it well. It means that you're now leading edge. There's only 2 or 3 companies that can do that, including things like TSMC. But more recently, you've had that real drive coming through from the demand side as well, which has been around AI, of course. And one question that we do have repeatedly around sort of that outlook is how sustainable it is. For now, CapEx numbers coming out of sort of the hyperscalers still remain pretty strong. The real acid test is going to be, will that investment ultimately lead to higher returns for the companies that are spending on that CapEx? And that's sort of where the sort of jury is out at the moment. So we're still overweight IT, but have been taking down a bit of weight. The other areas, manufacturing excellence, which is, Asia still is the manufacturer to the world. Companies like Shenzhou, they manufacture sportswear goods, got a very dominant share in that. Hon Hai do high-end AI servers, as well as a lot of the Apple product. And then, of course, we've got a lot of exposure to domestic consumption as well. And that really comes through in, I think, 2 main areas: banks and insurance companies. Insurance penetration in Asia still remains really quite low when you compare it to, say, UK. And there's, to us, is quite a good runway for growth. And the banks generally are pretty well capitalized. They've got good returns on equity generally, and are therefore able to pay and sustain decent dividends. So we continue to like them. I know that I've already overrun, so I won't actually talk to these slides. And I will think that will conclude my presentation. So just to sum up, I think Asia income, I think, is an attractive income story, particularly for people who want diversification away from the UK. And I think the Schroder Oriental Income, from its long successful track record of investing in the region, has demonstrated that you can add value by doing that.
Thank you very much. Okay, Richard, thank you.